After 4 years of trading, these are the best RSI settings for each market phase. Whether the market is trending or ranging, I will show you the exact RSI settings you need to understand the current market conditions. But first, what exactly is the RSI period or length? The simplest way to understand this is RSI is calculated using the last n number of closing prices. For example, the default period is set to 14, which means you're calculating the trend based on the last 14 bars or candles. For example, if you're using a 1 minute chart, the RSI is showing you trend over the last 14 minutes. On a 1 hour chart, it's the last 14 hours, and on a daily chart, it's the last 14 days. But here's the main challenge. How do you decide which RSI settings are best for each market phase? I mean, every market is different. So now let me share with you my best RSI settings for each market phase. RSI period 20 or 25. Use a longer RSI period in a strong steady trend when the market is trending. Longer periods reduce the number of false signals. You won't be tricked into thinking the trend is over just because of a little pullback. RSI periods 5 or 9. If you're a more active trader who likes to dive in and out quickly, go for a shorter period like 5, 9. These are ideal for capturing quick momentum shift within the larger trend. Shorter periods makes the RSI ultra responsive to price movements. You can catch those mini pullbacks or spikes in the trend more quickly. Standard RSI period 14. The standard 14 period RSI is ideal for range bound markets where the price moves sideways between support and resistance level. Use it normally. Look for RSI values above 70 to signal overbought conditions and below 30 for oversold conditions.